D. Debunking Standard Dogma. The preceding discussion about arbitrage makes a small discussion of efficient market theory, EMT, also seem relevant. This doctrine became highly fashionable, indeed, almost holy scripture in academic circles during the 1970s. Essentially, it said that analyzing stocks was useless because all public information about them was appropriately reflected in their prices. In other words, the market always knew everything. As a corollary, the professors who taught EMT said that someone throwing darts at the stock tables could select a stock portfolio having prospects just as good as one selected by the brightest, most hardworking security analyst. Amazingly, EMT was embraced not only by academics, but by many investment professionals and corporate managers as well. Observing correctly that the market was frequently efficient, they went on to conclude incorrectly that it was always efficient. The difference between these propositions is night and day. In my opinion, the continuous 63-year arbitrage experience of Graham-Newman Corporation, Buffett Partnership, and Berkshire illustrates just how foolish EMT is. There's plenty of other evidence also. While at Graham-Newman, I made a study of its earnings from arbitrage during the entire 1926 to 1956 lifespan of the company. Unleveraged returns averaged 20% per year. Starting in 1956, I applied Ben Graham's arbitrage principles, first at Buffett Partnership, and then Berkshire. Though I have not made an exact calculation, I have done enough work to know that the 1956 to 1988 returns averaged well over $20. Of course, I operated in an environment far more favorable than Ben's. He had 1929 to 1932 to contend with. All the conditions are present that are required for a fair test of portfolio performance. 1. The three organizations traded hundreds of different securities while building this 63-year record. 2. The results are not skewed by a few fortunate experiences. 3. We did not have to dig for obscure facts or develop keen insights about products or management. We simply acted on highly publicized events. And 4. Our arbitrage positions were a clearly identified universe. They have not been selected by hindsight. Over the 63 years, the general market delivered just under a 10% annual return, including dividends. That means $1,000 would have grown to $405,000 if all income had been reinvested. A 20% rate of return, however, would have produced $97 million. That strikes us a statistically significant differential that might, conceivably, arouse one's interest. Yet proponents of the theory have never seemed interested in discordant evidence of this type. True, they don't talk quite as much about their theory today as they used to, but no one, to my knowledge, has ever said he was wrong, no matter how many thousands of students he has sent forth misinstructed. EMT, moreover, continues to be an integral part of the investment curriculum at major business schools. Apparently, a reluctance to recant and thereby to demystify the priesthood is not limited to theologians. Naturally, the disservice done students and gullible investment professionals who have swallowed EMT has been an extraordinary service to us and other followers of Graham. In any sort of contest, financial, mental, or physical, it's an extreme advantage to have opponents who have been taught that it is useless to even try. From a selfish point of view, Grahamites should probably endow chairs to ensure the perpetual teaching of EMT. All this said, a warning is appropriate. Arbitrage has looked easy recently, but this is not a form of investing that guarantees profits of 20% a year, or, for that matter, profits of any kind. As noted, the market is reasonably efficient much of the time. For every arbitrage opportunity we seized in that 63-year period, many more were foregone because they seem properly priced. An investor cannot obtain superior profits from stocks by simply committing to a specific investment category or style. He can earn them only by carefully evaluating facts and continuously exercising discipline. Investing in arbitrage situations per se is no better a strategy than selecting a portfolio by throwing darts. When we own positions of outstanding businesses with outstanding managements, our favorite holding period is forever. We are just the opposite of those who hurry to sell and book profits when companies perform well, but who tenaciously hang on to businesses that disappoint. Peter Lynch aptly likens such behavior to cutting the flowers and watering the weeds. We continue to think that it is usually foolish to part with an interest in a business that is both understandable and durably wonderful. Business interests of that kind are simply too hard to replace. Interestingly, corporate managers have no trouble understanding that point when they are focusing on a business they operate. A parent company that owns a subsidiary with superb long-term economics is not likely to sell that entity regardless of price. Why, the CEO would ask, should I part with my crown jewel? Yet that same CEO, when it comes to running his personal investment portfolio, will offhandedly and even impetuously move from business to business when presented with no more than superficial arguments by his broker for doing so. The worst of these is perhaps, you can't go broke taking a profit. Can you imagine a CEO using this line to urge his board to sell a star subsidiary? In our view, what makes sense in business also makes sense in stocks. An investor should ordinarily hold a small piece of an outstanding business with the same tenacity that an owner would exhibit if he owned all of that business. Earlier, I mentioned the financial results that could have been achieved by investing $40 in the Coca-Cola Company in 1919. In 1936, more than 50 years after the introduction of Coke, and long after the drink was firmly established as an American icon, Fortune did an excellent story on the company. In the second paragraph, the writer reported, "Several times every year, a weighty and serious investor looks long and with profound respect at Coca-Cola's record, but comes regretfully to the conclusion that he is looking too late. The specters of saturation and competition rise before him." Yes, competition there was in 1938 and in 1993 as well, but it's worth noting that in 1938, the Coca-Cola Company sold 207 million cases of soft drinks. If its gallonage then is converted into the 192-ounce cases used for measurement today, and in 1993, it sold about 10.7 billion cases, a 50-fold increase in physical volume from a company that in 1938 was already dominant in its very major industry. Nor was the party over in 1938 for an investor. Though the $40 invested in 1919 in one share had, with dividends reinvested, turned into $3,277 by the end of 1938. A fresh $40 then invested in Coca-Cola stock would have grown to $25,000 by year-end 1993. I can't resist one more quote from that 1938 fortune story. It would be hard to name any company comparable in size to Coca-Cola and selling, as Coca-Cola does, an unchanged product that can point to a 10-year record anything like Coca-Cola's. In the 55 years that have since passed, Coke's product line has broadened somewhat, but it's remarkable how well that description still fits. Charlie and I decided long ago that in an investment lifetime, it's too hard to make hundreds of smart decisions. That judgment became ever more compelling as Berkshire's capital mushroomed and the universe of investments that could significantly affect our results shrank dramatically. Therefore, we adopted a strategy that required our being smart, and not too smart at that, only a very few times. Indeed, we'll now settle for one good idea a year. Charlie says it's my turn. The strategy we've adopted precludes our following standard diversification dogma. Many pundits would therefore say the strategy must be riskier than that employed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. In stating this opinion, we define risk, using dictionary terms, as the possibility of loss or injury. Academics, however, like to define investment risk differently, averring that it is the relative volatility of a stock or portfolio of stocks, that is, their volatility as compared to that of a large universe of stocks. Employing databases and statistical skills, these academics compute with precision the beta of a stock, its relative volatility in the past, and then build arcane investment and capital allocation theories around this calculation. In their hunger for a simple statistic to measure risk, however, they forget a fundamental principle. It's better to be approximately right than precisely wrong. For owners of a business, and that's the way we think of shareholders, the academic's definition of risk is far off the mark. So much so that it produces absurdities. For example, under beta-based theory, a stock that has dropped very sharply compared to the market, as had Washington Post when we bought it in 1973, becomes riskier at the lower price than it was at the higher price. Would that description have then made any sense to anyone who was offered the entire company at a vastly reduced price? In fact, the true investor welcomes volatility. Ben Graham explained why in Chapter 8 of The Intelligent Investor. There, he introduced Mr. Market, an obliging fellow noted above, who shows up every day to buy from you or sell to you, whichever you wish. The more manic depressive this chap is, the greater the opportunities available to the investor. That's true, because a wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses. It's impossible to see how the availability of such prices can be thought of as increasing the hazards for an investor who is totally free to either ignore the market or exploit its folly. In assessing risk, a beta purist will disdain exclaiming what a company produces, what its competitors are doing, or how much borrowed money the business employs. He may even prefer not to know the company's name. What he treasures is the price history of its stock. In contrast, will happily forego knowing the price history and instead will seek whatever information will further our understanding of the company's business. After we buy a stock, consequently, we would not be disturbed if the markets closed for a year or two. We don't need a daily quote on our 100% position in C's or H.H. Brown to validate our well-being. Why then should we need a quote on our 7% interest in Coke? In our opinion, the real risk an investor must assess is whether his aggregate after-tax receipts from an investment, including those he receives on a sale, will, over his prospective holding period, give him at least as much purchasing power as he had to begin with, plus a modest rate of return on that initial stake. Though this risk cannot be calculated with engineering precision, it can in some cases be judged with a degree of accuracy that is useful. The primary factors bearing upon this evaluation are 1. The certainty with which the long-term economic characteristics of the business can be evaluated. 2. The certainty with which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flows. 3. The certainty with which management can be counted on to channel the reward from the business to shareholders rather than to itself. 4. The purchase price of the business. 5. The level of taxation and inflation that will be experienced and that will determine the degree by which an investor's purchasing power return is reduced from his gross return. These factors will probably strike many analysts as unbearably fuzzy since they cannot be extracted from a database of any kind. But the difficulty of precisely quantifying these matters does not negate their importance, nor is it insuperable. Just as Justice Stewart found it impossible to formulate a test for obscenity, but nevertheless asserted, "I know it when I see it," so also can investors, in an inexact but useful way, see the risks inherent in certain investments without reference to complex equations or price histories. The theoretician bred on beta has no mechanism for differentiating the risk inherent in, say, a single-product toy company selling pet rocks or hula hoops, from that of another toy company whose sole product is Monopoly or Barbie. But it's quite possible for ordinary investors to make such distinctions. If they have a reasonable understanding of consumer behavior and the factors that create long-term competitive strengths or weaknesses. Obviously, every investor will make mistakes, but by confining himself to a relatively few, easy-to-understand cases, a reasonably intelligent, informed, and diligent person can judge investment risks with a useful degree of accuracy. In many industries, of course, Charlie and I can't determine whether we are dealing with a pet rock or a Barbie. We couldn't solve this problem, moreover, even if we were to spend years intensely studying those industries. Sometimes our own intellectual shortcomings would stand in the way of understanding, and in other cases, the nature of the industry would be the roadblock. For example, a business that must deal with fast-moving technology is not going to lend itself to reliable evaluations of its long-term economics. Did we foresee 30 years ago what would transpire in the television manufacturing or computer industries? Of course not. Nor did most of the investors and corporate managers who enthusiastically entered those industries. Why then should Charlie and I think we can predict the future of other rapidly evolving businesses? We'll stick instead with the easy cases. Why search for a needle buried in a haystack when one is sitting in plain sight? Of course, some investment strategies, for instance, our efforts in arbitrage over the years, require wide diversification. If significant risk exists in a single transaction, overall risk should be reduced by making that purchase one of many mutually independent commitments. Thus, you may consciously purchase a risky investment, one that indeed has a significant possibility of causing loss or injury, if you believe that your gain, weighed for probabilities, considerably exceeds your loss comparably weighted, and if you can commit to a number of similar but unrelated opportunities. Most venture capitalists employ this strategy. Should you choose to pursue this course, you should adopt the outlook of the casino that owns a roulette wheel, which will want to see lots of action because it is favored by probabilities, but will refuse to accept a single huge bet. Another situation requiring wide diversification occurs when an investor who does not understand the economics of specific businesses nevertheless believes it is in his interest to be a long-term owner of American industry. That investor should both own a large number of equities and space out his purchases. By periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. On the other hand, if you are a know-something investor, able to understand business economics and to find 5 to 10 sensibly priced companies that possess important, long-term competitive advantages, conventional diversification makes no sense for you. It is apt, simply, to hurt your results and increase your risk. I cannot understand why an investor of that sort elects to put money into a business that is his 20th favorite, rather than simply adding that money to his top choices. The businesses he understands best and that present the least risk, along with the greatest profit potential. In the words of the prophet Mae West, too much of a good thing can be wonderful. We continually search for large businesses with understandable, enduring, and mouth-watering economics that are run by able and shareholder-oriented managements. This focus doesn't guarantee results. We both have to buy at a sensible price and get business performance from our companies that validates our assessment. But this investment approach, searching for the superstars, offers us our only chance for real success. Charlie and I are simply not smart enough, considering the large sums we work with, to get great results by adroitly buying and selling portions of far from great businesses. Nor do we think many others can achieve long-term investment success by flitting from flower to flower. Indeed, we believe that according the name investors to institutions that trade actively is like calling someone who repeatedly engages in one-night stands a romantic. If my universe of business possibilities was limited, say, to private companies in Omaha, I would first try to assess the long-term economic characteristics of each business. Second, assess the quality of the people in charge of running it. And third, try to buy into a few of the best operations at a sensible price. I certainly would not wish to own an equal part of every business in town. Why then should Berkshire take a different tack when dealing with the larger universe of public companies? And since finding great businesses and outstanding managers is so difficult, why should we discard proven products? Our motto is, if at first you do succeed, quit trying. John Maynard Keynes, whose brilliance as a practicing investor matched his brilliance in thought, wrote a letter to a business associate, F.C. Scott, on August 15th, 1934 that says it all. As time goes on, I get more and more convinced that the right method in investment is to put fairly large sums into enterprises which one thinks one knows something about, and in the management of one which thoroughly believes. It is a mistake to think that one limits one's risk by spreading too much between enterprises about which one knows little and has no reason for special confidence. One's knowledge and experience are definitely limited, and there are seldom more than 2 or 3 enterprises at any given time in which I personally feel myself entitled to put full confidence. During 1987, the stock market was an area of much excitement but little net movement. The Dow advanced 2.3% for the year. You are aware, of course, the roller coaster ride that produced this minor change. Mr. Market was on a manic rampage until October, and then experienced a sudden, massive seizure. We have professional investors, those who manage many billions, to thank for this turmoil. Instead of focusing on what businesses will do in the years ahead, many prestigious money managers now focus on what they expect other money managers to do in the days ahead. For them, stocks are merely tokens in a game, like the thimble and flat iron in Monopoly. An extreme example of what their attitude leads to is portfolio insurance, a money management strategy that many leading investment advisors embraced in 1986 to 1987. This strategy, which is simply an exotically labeled version of the small speculator's stop-loss order, dictates that ever-increasing portions of a stock portfolio, or their index future equivalents, be sold as prices decline. This strategy says nothing else matters. A downtick of a given magnitude automatically produces a huge sell order. According to the Brady Report, $60 billion to $90 billion of equities were poised on this hair trigger in mid-October of 1987. If you've thought that investment advisors were hired to invest, you may be bewildered by this technique. After buying a farm, would a rational owner next order his real estate agent to start selling off pieces of it whenever a neighboring property was sold at a lower price? Or would you sell your house to whatever bidder was available at 9:31 on some morning, merely because at 9:30 a similar house sold for less than it would have bought on the previous day? Moves like that, however, are what portfolio insurance tells a pension fund or university to make when it owns a portion of enterprises such as Ford or General Electric. The less these companies are being valued at, says this approach, the more vigorously they should be sold. As a logical corollary, the approach commands the institutions to repurchase these shares, I'm not making this up, once their prices have rebounded significantly. Considering that huge sums are controlled by managers following such Alice in Wonderland practices, is it any surprise that markets sometimes behave in aberrational fashion? Many commentators, however, have drawn an incorrect conclusion upon observing recent events. They are fond of saying that small investors have no chance in a market now dominated by the erratic behavior of the big boys. This conclusion is dead wrong. Such markets are ideal for any investor, small or large, so long as he sticks to his investment knitting. Volatility caused by money managers who speculate irrationally with huge sums will offer the true investor more chances to make intelligent investment moves. He can only be hurt by such volatility if he is forced, by either financial or psychological pressures, to sell at untoward times.